Welcome back. Markets once again betting heavily on a September rate cut following Chair Powell's much talked about pivot in Jackson Hole on Friday. Joining me now to discuss, David Zervos. He's Jefferies chief market strategist, also said to be on the list of possible next Fed chairs. Welcome. I think it's our first interview. I'm glad to welcome you to our program.
Good to be here, Scott.
You happy with what you got from Jackson Hole?
I am. I think it was a pivot toward a lot of what folks like myself and many others have been saying, that this Fed seemed to be a bit stubborn with its views on inflation, with its views on tariffs, with its views even on the employment situation. So I liked the pivot. I liked the changes in the long-term goals as well. I think there were a couple things in there that made me happy overall. But, it's a little late, Scott. There's no reason really other than political reasons that we've had to be waiting this long, I believe, for a sequence of rate cuts.
Well, I mean, wouldn't you give them at least some benefit of the doubt in the fact that we all remember what happened in early April in the big show at the White House when the president held up the board with those high numbers on there for what the tariffs are going to be? Can't you understand that Fed Chair Powell looked at that and said, okay, this is a little different than what we were anticipating. Now maybe we need to wait and see what happens. What's wrong with that?
Well, I think two things are wrong with that. The first is that we know that this president is a tactician, that he's a negotiator, and he has an art of the deal strategy. So this was, I think, very much in the spirit of all of his negotiations, maybe a little larger or more aggressive than usual, but I think it was the opening gambit in a game, a very high-stakes game to try to get a more cooperative and fairer trading landscape built for the U.S., and I think that's largely what happened. And as these countries started coming to the table and as it became very clear that this tactic was working, and it was becoming clear relatively quickly, people got to the table fast when they saw those numbers. I think that, that a lot of the worries and, constant allusions to uncertainty were not warranted. And the markets were really telling the Fed that. The markets were understanding what was happening a lot earlier than I think the FOMC was.
Well, not initially. I mean, I think we all remember what happened in the market. I mean, as wearing your chief market strategist hat at Jefferies, you're telling me you didn't look at those numbers and think to yourself, like, okay, maybe I need to rethink what the market may do in the weeks, if not months ahead, if these numbers are even close to the reality on the board.
Well, again, I took the tack, Scott, with our clients and my writing and the conference calls and Zooms that I held with our clients, as well as my appearances on CNBC as a contributor, to say that this was a tactic, that this was the goal was to get fairer, more open trade, to get tariffs actually reduced in the end that are put upon us, which has happened, to have a fairer currency landscape, so that our currency is not being manipulated in those trade negotiations and those trade structures. So I took it very much from a positive angle, recognizing the risks, recognizing the markets, and you always have to be respectful of the markets. But I was I wasn't a lone wolf, but I certainly wasn't in the camp of many of my competitors that were instantly calling for recessions. I believed it was a tactical game, and I think it came out to be a tactical game. Again, I don't want to say that it happened immediately, but I think by the time we got to May and June, the markets were really figuring out what this really was, and we were starting to come back quite dramatically. And it wasn't because the Fed was helping. The Fed was actually keeping this a little messier than it needed to be.
I mean, on that note, what's interesting to me is that here you have stocks at record highs. You have credit spreads, which are amazingly tight. You have the economy, by all accounts, still doing pretty well. And I'm sure you would make the argument, and maybe you already have, that inflation obviously wasn't the problem that some thought that the tariffs were going to cause. So if I painted that picture for you, you would say, well, Jay Powell's a pretty good painter. He's actually done pretty well under all those circumstances. But why aren't you saying that?
Because I think monetary policy is incredibly restrictive based on the the models, or I didn't even want to say models, but based on the history of where I think we've come from. If you go back to pre-COVID periods, we sat at 2% interest rates with a Fed balance sheet that was basically right around here in terms of its size relative to the size of the economy, about 20% of GDP. And I think we can have a rate structure that is significantly lower, that would be not restrictive, that would allow this economy even more runway to take off, particularly as we transition away from many of the hangovers that we've had from the Biden administration, in particular the large government excesses, both the deficit and debts, as well as many of the other programs on the regulatory side. So we're shifting this economy. We're going to go through what the Treasury Secretary has called reprivatization. That's going to create a couple of little bumps and wiggles for a few quarters, and maybe we've already seen some of that. We may see another little bit of that. Why have monetary policy stand in the way of that process or make it a little bit more complicated? It should be easing back, and it should be respectful of the idea that we may have some jitters or hiccups in the job market as we move jobs out of the public sector back into the private sector. And I think that's a big part of what's going to happen in the second half of this year and into we're already in the second half, but through Q4 and into 2026. So I really just think monetary policy isn't a necessary condition for us to do well going forward. I think we're doing pretty well. We're going to do even better. But why tie one hand behind our back? Why make it harder when there's no reason to make it harder? This idea that everything's so good, things could be better. We could have a 3.5% or a 3.25% unemployment rate like we had back in 2019. That's 700,000 plus jobs that are left on the table.